Hi, Jim Gore from Thor Wealth Management. I want to talk to you today about investment psychology. If you look at Black Friday, people are lined up outside stores to get those sales because things are being sold at 50-60% off. It is totally different in the stock market because if you go back to 2009 when things were selling at a 50-60% discount, it was like crickets, no one was there. However, when the market is selling at 150% premium and paying more, that's when people get excited. And if you look at this chart here, this is looking at the cycle of investment psychology. When you go to optimism to euphoria, back to despondency, back to optimism, and this always has occurred. And if you just think about back in 2009, that's when people were very despondent. Today, we're seeing a lot of people getting that thrill and euphoria in U.S. large company stocks. We saw that 2 years ago in Bitcoin with euphoria, and then right before it came down significantly. And then last year just with the marijuana stocks. And why do we think that people should be concerned about the stock market and euphoria? Is because we're talking to people and we're seeing complacency from individuals right now where they're not worried about the stock market at all. They think stocks are going to continue to go up all the time, especially U.S. large companies. They are underweight international securities in a major way, and just let the good times roll, and that's usually when things are the diciest. One of the things that we like to go back and look at is facts and figures and where we are right now from prices in the stock market compared to history. In this chart, we're actually seeing this is looking at two indicators. One is the S&P 500 price to sales ratio or price to revenue. And you can see right now that the price to revenue is higher than it was in 1999 at its peak and higher than 1929. Same thing for price to gross national products. We have two indicators right now that are showing that U.S. large companies are at their highest prices ever. What this means to us is that you're taking more risk being in U.S. stocks. The next chart, which is taking it more to an individual level, is this: you're looking at how many hours it takes the average worker to work before he can buy one share of the S&P 500. This is even more dramatic. Right now, they have to work almost 140 hours to get one share of S&P 500, where back in 1999, it was about 105 hours that they had to work. So you're looking at about 30% more overtime or hours worked to get one share of the stock market. This is just showing that the prices are high. We believe we might be closer to that thrill euphoria level. And there's other areas to put your money where we believe you're going to be taking less risk and achieving higher rates of return over the next 5 to 7 years. If you are fully invested in U.S. large companies, this is something that you should take a look at in your portfolio and diversify. If you need help, please give us a call here at Thor Wealth Management.